Hello, everyone, and welcome to Unscripted Equity Curiosity, a Hedgeye podcast. My name is Ami Joseph. I'm the sector head for technology here at Hedgeye, and with me today is Andrew Freedman, as always, our sector head for communications here at Hedgeye. Today, we have a special guest. His name is Rob Simone. Many of you know him. He is Hedgeye's REITs analyst. He is an outspoken advocate of justice and truth. He does not wear tights yet, but he might have a cape. And we're going to interview Rob today. And Rob, thank you so much. We're very excited to have you here. This is going to be season 3, episode 10 of Unscripted Equity Curiosity. So something that we're very proud of in terms of the amount of effort we've put into this and the library of podcasts that we've put out there. We're very excited about the content, very rich content. And we're really excited to add your voice to that content. So with that, I'm going to ask you, I want to open it up to you for a sec and, or not for a sec, for the next little while, and maybe get started with kind of like a general question, which is, and I want to start on MPW. I don't want to stay on MPW, but I want to start on MPW because, and I'll explain for listeners.
Just getting right to it. I love it.
Yeah, right well, I was thinking either that, or I'm going to ask you, like, why are you a Yankees fan? But anyway, I for the listeners, like, you know, we're all in this world where we're trying to invest our dollars, and we're trying to, and generally speaking, I think, you know, market, we have, you know, macro views of markets, we have long-term, you know, profit growth views of markets and things like that. And, you know, I think we've all been educated around a lot of different important principles that have worked, or at least have worked in the past, and who knows if they'll work in the future. But one of the things that we all want to do is make sure that we're avoiding fraud. And because that's where your stock doesn't go down 15 or 20% against the market going up 15, 20%, that's where your capital goes to zero. So that's one of the things that we are all trying to keep our eyes and attention for. It's actually, like, again, sorry to go on with this intro, but like, it's actually not so easy to do, because the American culture, and I'm specifically calling it America, not you know, to differentiate against other cultures, just because in the last 5-6 years, most of the stocks that I've analyzed are American companies. But the American culture specifically has this sort of like marketing element to it. Like, it's like always be marketing. It's not always be closing. It's always be marketing, right? So someone asks you, how are you? Things are amazing. It's companies are like that. They have this, like, things are, you know, you might be listening to an earnings call where the company is, you know, the stock is down 25% after hours, and the company's telling you they just had a record quarter, right? So there's this marketing thing that we always have to sort of read between the lines around. And so I want to go right to MPW and just say, like, from the start, what was it? What was the first thing, the smoke signal, where you were like, something's not right there? What was that thing that tripped you? That, of course, then, you know, there was a sort of a long tail of stuff that came out of pursuing that research. But what was that first thing? And this is the goal, is, you know, me as an analyst and us as listeners, we're just trying to understand, like, you know, from a process perspective, what are the things we need to, we need to add to our antennas always in this area. So what are the antenna elements that we should be raising right now in the back of our heads in light of everything you've found?
Yeah, no, I mean, that's a great question. And by the way, really quick, thanks for having me. It's a pleasure to be here, and thanks for humoring me. I know I talk about this a lot, and it's interesting. So, like, before I answer that, there, like, something kind of popped in my head as you were speaking, that as an analyst, as someone that, you know, and I know you guys, but you guys may disagree or agree with this, but one of the things that we have to be cognizant of as analysts trying to, you know, help our subs make money, right? Like, ultimately, that's kind of the goal. You know, there are times in the cycle where, you know, frauds work, unfortunately. And so if you have something that, or frauds, or, like, you know, what Chanos would call legal frauds, they work, and you have to be cognizant of that. So, like, you as an analyst may, you know, think that you found something, you know, really kind of, I don't know, maybe interesting or confusing, or something that doesn't make a lot of sense. and the stock will like continue to rip in your face despite everything you found or you think you found. And so like one of the things that I kind of learned as I got to Hedgeye is that there's time and space during which, but finding something like this will work to the downside as a short. So let me just, because you don't want to get squeezed, you get the life squeezed out of you and get caught on the wrong side and like lose your clients a lot of money. But with that said,
I'll jump in for a sec on that.
Yeah, sure.
Because I know, I see where you are. And I just want to share like a bigger sort of picture on that. I agree. However, you are commenting on it from the picture of the trees, and maybe the forest is that, and I've been there, and I probably made a lot of mistakes around, managing the tree in the moment. But at the forest level, like looking back at things, even if those stocks go up, they have to remain on the other side of the position monitor or the balance sheet, or however you want to title it, in terms of like your asset exposure. And so,
Sure.
And so even though it's going up, and you'll have lots of people chirping you like, dude, you suck, this thing's going up, it's up 100%, and you're shorting it, you idiot. Like, and believe me, we've done this. It's exactly the kind of thing to stay with, because you're calling out, especially in our seats. Like maybe if you're on the buy side, you've got to be careful because that's career risk, but you've got to keep it there because there's too much, because it's like a signal to the rest of the market that this isn't one of the good companies. Go invest elsewhere. So it's a very, very powerful, excuse me, I'm having a little sore throat today, but it's a very powerful signal. And I would say, I'm thinking specifically, Joseph and I had this with a company called Medallia, ticker was MDLA. It was not a fraud. But was it a liar? Exactly. Like it was like basically, it wasn't like everybody else. Okay. And they were doing, they were saying one thing and doing another, and so on and so forth, and all these kinds of interesting things. We called that out for a long time. And, it squeezed down, and then it squeezed back up and things like that. And of course we got scared and covered at some point and kept it on the short bench, but not on the active shorts. But it should have, in looking back, I should have just kept it on the actives the whole way, because when you find, even just forget about short of the frauds, but like when you find the fakers, yes, it's like Keith says, risk happens very slowly and then all at once, right? So if you find the fakers, you stay with it, because it's hard to anticipate exactly where the moment is that they are going to hit that wall. But you stay with the short because it's such a powerful signal. Okay, I just wanted to comment on that. Sorry, because that's a general, by the way, process point that I think if you take a huge step back, drink a lot of beer, think about it, I think you'll probably agree with me in terms of like not over managing against something like that.
Yes. Yeah. Well, okay. So I agree with you, by the way. And maybe to answer the question, kind of like take it back to the beginning. So I had heard about MPW for years, and never covered it actively. I've told the story a couple times, but you guys know how this is. Like you'll go to a conference, you'll be at the bar with a bunch of buy-siders, kind of like talking about a bunch of meetings you just had, and inevitably that like one company will come up and it'll be like, oh man, can you believe what these guys just did? Or can you believe the story they're telling? It's ridiculous. It's fraud. They're lying to you, all of the above. Right. And over the years, I covered lodging, I covered self-storage. The REIT world is broken up into subsectors. Towers, data centers, the areas that touch you guys most, directly perhaps. But what I would say is that like MPW was always, and this is Medical Properties Trust, was always kind of like on that list of conversation, right? And I guess, over the years I had heard about it, I never really dug in. And it was actually around the time that we made Invitation Homes a short recommendation early last year, which was very controversial for a variety of reasons. That I was having client calls, and a couple different clients, like independently of one another, just asked me in passing, like, "Hey, do you think MPW is going to have to cut its dividend?" And at the time, I didn't have a view on it because I hadn't spent any time on it. And the first two times I kind of like didn't really pay it much mind, but the third and the fourth time, I remember saying to myself, like, "Oh my God, I should understand this," because like well, first of all, there's a question that people are asking each other and themselves that they don't know the answer to, and like it seems like it's a topical question, so like I better have a view on this. And so what I did was, or I better try to develop a view. And so one Friday, I printed out the annual report from the prior year, a couple of the earnings calls, and most importantly the proxy statement. So the DEF 14A, the proxy for the prior year, and you guys have probably heard me talk about this, but that's actually one of the most important parts in my process. I actually start by reading the proxy when I look at a REIT, and that's kind of like a weird place to start, right? Like usually, I don't know what you guys do, but like typically you'll start with like the 10K or an earnings call or an earnings report. To me, the proxy is such a powerful document, especially in the REIT space, because in the end, many of these businesses or these companies don't have an operating business or shouldn't. They're just owners of the property, and depending on the subsector, they'll hire a third party to actually run the business that occupies that asset. And healthcare and lodging, so Todd space, for a variety of reasons, like the owners are not, the REITs are not allowed to self-operate those assets. And so what it boils down to is you have like a kind of like a quasi publicly traded private equity fund, or just a pure capital allocator. So I guess what I'm trying to say is, like, you want to understand the incentives and how the company is incentivizing the management team and how they're laying out their goals to understand where the puck is going as opposed to where it is, to draw like a sports analogy. And one of the first things that caught my eye, and I had seen this before with a company called Commonwealth REIT years ago, very controversial story, perverse incentives, like bad shareholder, bad corporate governance. One of the things that they did was compensate themselves based on acquisition volume. And MPW does the same thing. So like if you go to their proxy statement and open it up, and just go to the compensation discussion. Even this year, after everything that happened last year, they're still targeting dollar acquisition volume as a performance metric. Now, as a capital allocator, like think about what that means. You're incentivizing effectively the management team to go out and A, buy anything, and B, potentially to pay the highest price, because those are the two easiest ways to meet a dollar acquisition volume target. So like become an asset aggregator as opposed to being like a prudent, prudent steward of capital, so to speak. And when I read that, first of all, it's exceedingly rare to see that. Like over time, the REITs have kind of like gotten the message and dialed that back. And when I saw it, I remember thinking, and this was like a Friday night after my kids went to sleep, I locked myself in my office and I was just like, reading through a bunch of stuff. And before I knew it, it was 3 a.m. I just kind of like got down this rabbit hole. But I knew at that point kind of like how the story was going to evolve and where it was going to end up. But the second one, that was the first flag. But the second flag was, there's so many with this company. It's almost like hard to list them all out. But another big one was kind of, figuring out or discovering that MPW as a REIT, which is supposed to be an investor in real property, right? Like your goal, your charge, the reason why REITs exist is to deploy money into real estate. and allow, public shareholders to participate in the economics of that real estate via distributions over time, right? To broaden the access to real estate beyond just like owning a building directly. And one of the things this company did in early 2021, it originated a loan, a $335 million loan, to the CEO of its largest tenant, Steward Health, who pledged his equity as collateral against that loan. And this individual used the proceeds effectively to buy out Cerberus as the prior equity owner of Steward. So I know I said a lot there. Basically, what MPW did, it allowed a counterparty, a significant counterparty, an individual, to buy out the company that he ran that pays rent back to MPW. So they financed the change of control. And regardless of what, like you could stop like right there. I could have stopped right there, but like, oh my God, this is like unfreaking believable. Like, I mean, I've never seen that before, especially not in this size, but that should never happen, ever. There's no reason, there's no world where that loan should be made. It's completely inappropriate. I'm not saying it's illegal, but from like a purpose and a capital allocation standpoint, it shouldn't exist, and it makes no sense. So like there's something, my antenna was up, I guess, to use your words, that something else like, potentially bad or perverse or maybe even nefarious was going on here. And I just kind of decided to really dig in because I thought that like I'd found something unique.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street.
Go to hedgeye.com/research to subscribe.
Enjoy the rest of this episode.
I love it. I made notes along the way, and one of those I know you said before, but that you started the proxy. That's fascinating of its own accord, and probably something we'll touch on again. But the acquisition volume that you mentioned, how could that be legal, right? Like if you're listening to this, you're probably thinking like, why doesn't the SEC flag these things? Like, why is that legal? Why is that not an accounting thing that's kind of like obvious, there's some kind of like fundamental impairment to that, because it's like a long time ago, I found a company that was essentially, kind of like buying management was judged on revenue, and they were buying revenue. They had a joint venture. Their CapEx was recognized as revenue by the JV, and then they recognized, they recognized their relevant portion of the JV as revenue. So like obviously, like any revenue shortfall, they could always make up because they would increase CapEx at the end of the quarter and recognize that as in the top line, and that was what people cared about at the time. So, and it's interesting actually when I had the CFO on taped saying it. Explaining she didn't realize what she was explaining at the time. I think she wasn't intentionally trying to deceive people. I think this was sort of like one of those accidental things. So pretty interesting on the acquisition volume front. And then the other thing you mentioned is on the operations front. And what do you mean they can't operate the properties? That's something about REITs I didn't really understand, because the only REITs I've ever looked at are like Equinix. Of course they operate their properties. No, they have to. So explain that to me about the can't operate element. And then, the other note I made, absolutely. Like some lending, any kind of transaction like this, like that is lending money to somebody to go buy it. This is obviously like so many red flags around this. It's amazing that you caught that. That's awesome. Did you mention that was in the proxy itself, or where did that show up? Like, where did you find that?
Yeah, sure. So maybe the second part first. Well, that was kind of like the next step in digging in. I just started, I said that I was, I guess, up until 3 a.m. Something caught my eye where, in 2021. So first of all, actually, you guys will appreciate this. So what was interesting here is that this loan was originated in January of 2021. Basically, I worked out a timeline. So like sometimes when you draw things out on a piece of paper or on a whiteboard, it kind of like it tells a bigger story than just like reading the words on a page. And basically what happened was they made this loan to this individual. They disclosed it. First of all, they didn't disclose it on the fourth quarter, right? So like make the loan in January of 21, report 4Q earnings in February, don't talk about the loan at all, even though like I would argue it was material and to a related party, et cetera. But what was interesting is like this company, it reports gross investment in different tenants. And it basically like Steward Health, this largest tenant to MPW, its gross asset balances went up by about $330 some odd million. So a big jump, right? Like it was whereas, you know, it would maybe jump $10, $20 million a quarter, depending on how much CapEx MPW invests. And that's another issue, by the way, we can talk about that separately. But anyway, there was a big jump in the assets and it seemed to be undisclosed. And then the next quarter, the first quarter, they talked about it on the call and in the 10Q as being a loan made to Steward Healthcare System. So like disclosing it as to the entity. The following quarter in the 10Q, they changed the disclosure to affiliates of Steward Healthcare. So like a slight little change there. It went from the entity itself to affiliates of the entity. And then I'm like, that's weird. Okay, so like that's a flag, right? Like, so you didn't disclose it, then you disclosed it, then you changed the disclosure. And what was interesting was they priced an equity offering the day before the loan was made. So like just red flags everywhere, red flags flying off the page. You didn't disclose it up front. You made it to a related party. You mischaracterized it. Then you recharacterized it. And you didn't actually disclose fully that like this individual had pledged his equity as collateral until Hedgeye showed up and started making noise. So it just like, you look at that and it's just a horrible fact pattern. And it's kind of, again, it's one of those things that like puts your antenna up. So and I just lined out a timeline on a whiteboard or on a piece of paper, right? So like when you look at it that way, it's pretty obvious to me that there was an intent to deceive or to like obfuscate, which is a red flag. And then, sorry, go ahead.
No, go ahead, please.
Yeah. And then I think the first question was, what was the first? Oh, the operating, like REITs not operating their assets.
Yeah.
So. Yeah. So this has to do with like all REIT classification is tax treatment. It if you qualify as a REIT with the IRS, it basically allows you to forego paying corporate taxes and like function as a pass-through entity, where everyone who owns the REIT or shares of the REIT gets taxed on their dividends at an individual level. But in exchange for that, there are all these, requirements that you have to meet in order to like qualify as a REIT or like stay inside quote unquote REIT rules. One of the requirements is that it's called a good income, bad income test for REIT purposes. So like 90% of your income or your rent or your revenue has to be in the form of rent or mortgage interest derived from real estate. And what happens is in some property sectors like healthcare, for example, where there are like, different levels of service and ancillary services, or in lodging where you have like a food and beverage operation and spas and like all this other stuff, a significant portion of the revenue doesn't meet requalifications. And this is where it gets a little complicated, but basically what the tax code lets you do is an intra-INTRA company transaction where you set up a subsidiary that's wholly owned by the REIT. It's called a TRS, a taxable REIT subsidiary. Basically, the REIT leases, the corporate entity leases, the operating partnership leases the property to a TRS who pays rent back to the REIT. to lease it, but that gets eliminated as an intercompany transaction. And then the TRS hires a third-party manager. So like in Todd's world, let's take Diamond Rock, for example, or Sunstone. Each property is held it's leased to a TRS, and the TRS goes out and hires Hilton or Marriott or Hyatt to manage the company, and they pay that manager fees essentially based on revenue, and the REIT winds up earning rent from the TRS to meet REIT qualifications. It's a technicality. It's kind of like a way of getting around REIT rules, but the point is you still have to have that third party operate the asset because of all the non-REIT income. Does that make sense?
Yeah, I'm just trying to translate in my head to like Equinix, for example. Like, does that mean that every data center that they have, they hire some third party to manage and run it, and the customers are paying that third party? I mean, in that world, like the Equinix brand has been very important for attracting large clients like Amazon to rely on them and things like that.
Well, I think in Equinix and DLR's case, for example, they stay inside the retest because the overwhelming majority of their revenue is still in the form of rent or fees to lease cabinet space. So I believe that the limitation is 90%. You can have like 10% of your revenue be like quote unquote bad REIT income before you trip the test, and they probably fall within that threshold. Whereas in the case of like a full service hotel, you might have 20-30% of your revenue from food and beverage operations. It's just like a percentage threshold that you have to meet in order to fall within it.
Okay. So like bottom line, does Equinix actually manage and run its own properties, or there's a third party running and managing their properties, or DLR?
They internally manage and run their own property.
Okay. That's the part I just wanted to make sure to clarify. Okay. So
Yep.
Let's stay we're going to come back to other antenna items from the balance sheet and stuff, or on other antenna items in general from the proxy and things that stand out. And we could talk about other companies and not just MPW. I almost feel like there's like a biblical sentence here, and the rest of the story of MPW and Rob Simone's amazing analysis are written in the book of so and so. Actually, that's something to think about. You should probably I would say you heard it here first. Worth writing a book on this one. This is like a life moment, I think, probably. And so many amazing lessons that everyone can learn from it in terms of avoiding situations like this, and also kind of like, more that this is crap they can't do, like meaning like not that they are going to deceive, but occasionally they're sort of like this, like, yeah, why don't we capitalize? It's like yeah, that would help us a lot. That would drive a lot of profits. Can you guys hear me okay?
Yep, gotcha.
Okay, got it. So just staying with data centers for a sec. For those who don't know, data center REITs, these are really interesting businesses. Basically, you find a space that is centrally located to some degree. You bring enormous amounts of power and cooling to that space. So basically, you're working with the power companies and such to bring enormous amounts of wattage. Obviously, there's all kinds of hoops you have to jump through to have it zoned for that kind of thing. It literally could be in the basement of an office building or anywhere, as long as it can get licensed. And then and there's a connectivity reason to be there. And then you start kind of like bringing the parties to it, the different companies who all want to be interconnected and who need super fast connectivity. Think, lightning fast trading, or think about for like a game that is live, or any kind of thing like that you want to be, or software that's cloud hosted that needs to be kind of like no huge latency. This is one of the areas of how you can get around the slowness of the general internet, and you can accelerate yourself by being in these things, and you pay rent to the owner of the space. So the owner of these footprint areas are like DLR and Equinix and things like that. So this is a very interesting business. I don't know, like when I think about these things, I can think about a lot of positive drivers. I can think about some negative drivers. How do you tend to think about data centers in terms of the opportunities and the ones that you've dug into? Like, what are the good things? What are the bad things about the model that you can tell?
Yeah, definitely. So yeah, that's a big question. I mean, first of all, they're highly controversial right now. So very publicly, a friend of Hedgeye and obviously a legend in his own right, Jim Chanos and his firm have been very publicly short or advocating a short of DLR and Equinix. And I think obviously like they've been right so far for a variety of reasons. And I guess if I had to think about the positives and the negatives, and by the way, like full disclosure, I'm still, it's complicated to me because like I'm kind of like a bricks and sticks guy, and there's technologically is probably where like, I just recognizing my own weaknesses where I'm like not as well versed as like you guys are. But the positives, I guess, are that like I think about it within the context of the industrial and the logistics spaces. So basically, like taking I'm going to draw like an analogy, so like it'll come full circle and hopefully make sense in the end. But industrial and logistics, you're talking about warehouse space, right? It was kind of like this backwater in the REIT world for a long time, primarily serving industrial uses like manufacturing, heavy storage, shallow bay industrial, stuff like that. Like a lot of the stuff would be, positioned in like outside of industrial parks or like around the Port of Houston, for example. And it was kind of like, non-sexy, like, kind of just there and also very economically sensitive. And then along comes the Amazons of the world and kind of like the e-commerce revolution and the shift of consumption away from brick and mortar retail to e-commerce, and it caused this like massive renaissance in the industrial and logistics real estate space over the last decade, leading up through COVID, right? And what was interesting is that, like, if you think about Amazon and all of the different SKUs that it has to carry, the massive amount of space that it needs in each of its logistics centers, the heavy like space utilization with equipment and the Kiva robots, all of that stuff, it's a very capital intensive proposition. And so what Amazon and the others did was they decided, like, okay, let's, instead of putting this on our own balance sheet, and they do own some of their own logistics centers, but broadly, like, instead of having everything on balance sheet, instead of having to like tie up a ton of capital in an in-house development team and effectively create a REIT within Amazon, let's outsource this to the public REITs and a bunch of other private owners and developers to be like developers and owners of choice, and we'll just pay them rent, get all of this like heavy capital, get this capital tie up off our balance sheet and onto somebody else's. And so what it did was it created like this incredible demand for third party space from the Prologuses, the Dukes of the world, First Industrial. It just completely like, revolutionized the entire sector. And it became, believe it or not, simple warehouse space became like the darling of the REIT universe for the past, 5, 6, 7 years. And if you think about what that means, Amazon and, anyone else who runs an e-commerce business has a choice. They can either continue that model, or they can choose to bring it all back on balance sheet and undo the last like decade of investment and like supply chain building. And the way I think about the data center space, it's very similar. So the cloud, the cloud providers basically had the same choice. They can either in-house and put on balance sheet their entire data center infrastructure, or they can outsource that effectively to third parties who are responsible for, running, upkeeping, investing in the assets, and then like the service providers just pay rent, and it's like an asset light, higher margin model to them. So it creates this like perpetual need. That's probably the biggest positive. Now the downside of that, it like from the from the asset owner, like the landlord's perspective, is that it's incredibly capital intensive. So, and I think that's actually why, the short has been working of the data center space, like as we've seen with so many other like really capital intensive, cost of capital dependent businesses, is that like the marginal returns on a cash on cash basis are pretty thin to the data centers because of how much capital they have to invest themselves into their own business. And like the fact that over the last decade, as we saw with so many other companies, as rates came down, they financed themselves with like ever lower and lower costs of debt financing. And now that's in the process of reversing. So it's kind of like this double whammy of functional obsolescence, having to continuously pour a lot of maintenance capex into the buildings, and now suddenly having to like finance yourself at a much higher rate. It's really put the squeeze on these guys. So I know that's a long-winded answer, but like to me, from where I sit, that's why it's so challenging right now for them. I don't know if you guys have a view.
No.
So
So that just sounds like an interest rate short, right? Like interest rates were low for a long time. It allowed a lot of behavior. Now interest rates are high and it tightens up behavior. Is that, am I over? I know I'm oversimplifying, but like, did I get it? Did I get the punchline?
Hi, Robert McGrory here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything.
Go to hedgeye.com/research to subscribe.
And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
Yeah, I think so. But I also think that it kind of became, so that's like the liability side, quote unquote. On the narrative side, or like the asset side, there was kind of like this TINA, or there is no alternative trade, where a ton of money in the REIT dedicated space flowed into cell towers, data centers, the new alternative real estate sectors outside of the typical food groups like multifamily, office, retail, industrial, et cetera. And I think that like as that was happening, there was this big narrative that like there was this endless demand for this stuff that would consistently cause rental rates per kilowatt to increase to the sky. And so cap rates compressed, and a ton of capital moved into the space on like owning the equities. But underneath the surface, the return profile of the stuff, as Jim so adeptly pointed out, actually wasn't that great. So like when you, depending on how you calculate it, you're talking about cash on cash after investing a lot of how much maintenance capex you have to continuously pour into the stuff to upkeep it, mid single digit returns. And so like I guess you could make it, it's very similar to MPW in that respect. Like it doesn't work, or it's not economic because of the capital requirements biasing down the return profile. And the only way the model works is when you can finance yourself at low interest rates. So like in a way, it's almost like the low interest rate environment allowed the trade to continue and to really kind of promulgate. Whereas like contrast that with the cell tower space, it's so, Andrew probably could speak to this better than I even could, but it's so capital light or asset light, and the return profile is so high, that like, yeah, there'll be rate of change slowdowns, but the business doesn't have any existential risk because over time, these things compound with escalators into like the double digit, cash on cash return, kind of range. And so it matters, but it doesn't matter as much whether you're financing yourself at like 3% debt or 6% debt. Does that make sense?
Yeah, I get it. But I also think that, I guess it just also depends on the fundamental like drivers, right? Because if you think about that space, like more computing typically means we need more electricity. Obviously there are offsets, which is the move to, like a per workload basis, like, you're moving down the nanometers of semiconductors. And so you're basically getting, more output per piece of per unit of electricity. I'm sorry, I'm not so coherent this morning, but there's sort of like this like balance where you're constantly making your computing more effective on a wattage basis. However, that curve, that enablement actually just yields more volume demand for computing. So typically you'd see the overall need for wattage, and I'm bringing it all the way down to electricity because the more electricity you need, the more data centers you need. And typically this has only been up and to the right. I think there are maybe some geopolitical things to discuss about what could be a headwind to that, like, what might have been an underlying driver to overall, technology growth and computing over the last, 40, 50 years, let's say. But let's assume that curve, even if it slows, doesn't change. So I would say, like, then to me, the only thing that would make sense on the short side really within your space, like relative, I'm not talking about like, yes, businesses that were funded by low interest rates and now interest rates are high. If that's the business model, then okay, you're done.
Yep.
But within like relative to the rest of the space, like here you have demand drivers that are going to lead to fuller and fuller real estate, right? Like higher utilization per square foot or whatever. And more and the need for more of them. Whereas on the other side, in office REITs, you have serious headwinds to utilization and to, kind of like, the fill rates and so on and so forth. And those are also based on low interest rate businesses. So why not short those and be long data center ones, right? Like, isn't that the right trade? I don't explain that to me.
Yeah, sure. And no, it's a really good question. So there's why short them? Correct me if I'm wrong, but what you said and described, by the way, again, recognizing my own shortfalls, like I actually, I rely on, I don't just defer to, I rely on folks like you and your knowledge of the tech space and Andrew's knowledge of the comm space to like understand those demand drivers better than even I could. But what I do know is that like that may be, or what I think I know is that may be a time and space type issue, like Keith likes to say. Like sometimes you need time and space for that to play out. And the unfortunate reality on the REIT side is that one of the other requirements of being a REIT is that you have to pay out 90% of your taxable income as dividends. And so what a lot of these guys did, and this isn't just the data center space, I'm speaking to DLR specifically here, but other companies, they sized their dividends based on taxable income that was derived from low interest rates. And so that's another way of saying that like several companies now are effectively over distributing because as their their taxable income is now coming down from higher interest expense, they actually have flexibility to lower their dividends. But the problem is many investors have bought the stocks, especially like I'm thinking of passive dividend income funds, for example, have bought these stocks relying on or making a bet on not just sustained dividends at the current level, but also like growth in those dividends. And quite the opposite is happening right now. So I guess maybe another way of saying that is what you said may be true, may play out over a long period of time and work fine. But the problem is like many models may have to cut their dividend in the interim because they're effectively borrowing right now to fund it. Does that make sense? They're burning cash. They're burning internally generated cash. Yeah. So that makes
it's I agree, like the time and place thing. I agree with that. I think that's probably the best explanation. Also is also like if you look at the underlying driver, which has been cloud software for I'm assuming, right? I know 10 years ago when I was investing, by the way, in these before they were REITs, they were just tech companies, whatever, but they were I was invested in Telecity out of London, and I was in and around Equinix. I was at Putnam at the time doing international tech, so I was doing the international companies in the space, not Equinix, but obviously I had to follow Equinix as well. And what I would say, just like kind of like, you know, mentally, like I understand I'm assuming the last 5 years, 6 years, been driven by cloud. You mentioned e-commerce as well. And if you just look at Equinix against some of the cloud software ETFs, for example, it has in the last year, 5 years, even, let's say, it has like crushed them. And the absolute biggest period of outperformance has been between November of 2021 or so, like October, November 2021, when cloud software peaked, to today. And so there's something about that, yeah, I understand doesn't smell right, right? Like if the driver of your business is down a lot, does that mean your business, you know, should slow? That would be maybe that would be like where I would begin the investigation. But at the same time, one of the problems for cloud software is there's a lot of cloud software companies and they're competing with each other. And if their prices change, it doesn't necessarily, you know, if there's headwind to their adoption curve, it doesn't necessarily mean the underlying usage and utilization of their software goes. There just might be excess supply at that level as opposed to excess supply at the Equinix level, I guess. But maybe moving on. Sorry, go ahead.
Sure, go for it.
No, go ahead, please.
Lastly, on the data center side, like I kind of underestimated also in my initial understanding of data centers how important the power aspect of the whole equation is. Really, what determines pricing in the form of like quote unquote rents is access and availability of power. And so, like, one of the most important factors to kind of think about for the data centers, like maybe like a step removed from the cloud, like, you know, cloud computing, internal or compounded growth over time is like how much of the power available in the market has been spoken for and developed on. My understanding is that like there's been some tightening in Europe specifically. So like Frankfurt, Germany, for example, like all of the available power has been spoken for. And so there's a thought out there that like as that, and not just like the cost of energy and the cost of power goes up, but like it becomes more difficult to build on top of it, and all of it's been spoken for, it actually creates like a pricing power situation for the REITs that already have like an install base, or the landlords that have an install base. But like that also may be a longer tailed kind of story. So I guess we'll see. But that's like one of the, you know, the bull cases out there, I guess you could say.
Well, that's right. So that's interesting. It also points to maybe like the fundamental limitation of the business model, which is that fundamentally the data center REITs are reselling power that they don't make, and they don't control the pace of supply. So if they're like, hey man, we're full here at our gigawatts, we need another, you know, X amount, the power company might say, you know, no thanks. Like, you know, we're not building there right now. Actually, we have other things we're doing. And Absolutely. you're sort of screwed as the data center, and you turn around and you tell Amazon, you know, hey, sorry, I guess. So there is a limitation, because there's a middleman element to this business model that does not really control its fate. There's something there. I think that's probably maybe the first place to start investigating, because at some point you frustrate the largest customers of the world so much that they realize that they don't want to deal with a middleman anymore, who just basically adds a layer of pricing on top of the price of electricity, and they just need their own access at this point, direct to the source.
Yeah, I think that's right. And then it becomes kind of like a, I guess an IRR crossover analysis where does the increase overhead and capital load that Microsoft or Amazon or whoever, or I guess Salesforce would have to like in-house, does that more than offset the return, the incremental return from bringing the top line in-house? You know what I mean? Like that's like the whole debate that's going on. And I guess like what Jim and some of the other shorts in the data center space are betting is that like the hyperscalers are going to make that bet and in-house it, and it's going to kill the third-party data center business. Whereas like the bulls kind of say, well, like in a time where, all of their own businesses are slowing, they being the cloud providers are slowing, and they're maybe laying off people and like rationalizing their own cost structure. Are they going to be willing to dive headfirst into this really, really like heavy lift? So that's kind of like the long-term bull bear debate that's going on underneath the surface, I guess.
Yeah, I mean, like I would imagine that the best case scenario for the bigs are to do a little bit on their own, like enough to force the provider to get moving. But if they were going to whole scale go into this, you'd see them maybe like buy DLR or buy a large REIT or something like that in the space. So I don't.
And by the way, like that what you just said, getting back to the industrial and logistics example, and that's why I started with it. That's exactly what Amazon does with its warehouses. Like it owns a few, it outsources most, but it's kind of like a mix of the two, depending on the location, depending on what the rents are in the submarket, like depending on like the how accessible the labor pool is. Like it's kind of like a mix of both asset heavy, and asset light options.
Yeah, and by the way, what we're talking about now, but like power limitations and kind of like being sold out on power or whatever, I think actually could have effect on the industry itself, on my industry. Like the waves that could spill back are that if you can't add power in key data center locations, then obviously the price per watt is going to go higher, which means that workloads are going to cost more. And broadly, that means infrastructure as a service and computing is going to cost more. And so companies that are able to rewrite their software to be lighter and more nimble, and even down to, I would say this all the way impacts down to like an Intel or an AMD, where they have millions of lines of code on their transistors sitting there, and not all of them are useful and being done. Whereas, let's say the ASIC companies who are building purpose-built, or obviously, anytime you build in tech with like a fresh canvas, a clean slate, a tabula rasa, you're going to be much more efficient in the beginning, right? Obviously, there's a long curve, and you have legacy and debt and tech debt and things like that over time that you just don't have time to really prune and meet with. But it could actually influence the next decade of tech, where the lighter and more efficient the construction of the software, the more that company can actually flow its revenue and costs together, as opposed to others who may see their costs of operating the business run faster than the revenue growth. There's something there to waterfall into my space. I think, Andrew, I don't know if any of this affects yours. If not, we can move on. I've got another question, ready as well. Andrew, I don't know if you wanted to throw one in here.
Yeah, I mean, no, I've enjoyed the line of questioning, just listening. You guys are on a roll, so I'll kind of just let you run with it. I one question on MPW, because not to spend too much time on that one, but like I would just be interested, Rob, in like when you had your like aha moment, right? So you kind of like talked earlier about like when you kind of found something, like there was smoke, but I'm curious, like at what point did like you just see the light on this one? And I know you and I have had some interesting conversations on it. So I think I know your answer, but once you're once you're done on this topic with Ami, just maybe curious to hear that anecdote quickly.
Sure.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Ami, should we keep going, or should I go to that, or what? Up here?
No, yeah. Why don't we touch on that and then we'll come back. I've got another one ready to go that's on like a slightly pivot. So,
yeah, sure. Well, it's a really good question. Forgive me for stumbling here. It's such a.
Was it the John in Texas or?
Well, okay. So, all right. So let me give you there's two answers to that. One, the first answer was like, when did I figure out the business was broken? That just like assuming that there's nothing, fraudulent, right? Or like illegal going on. When did I figure out that the model was broken? There were two things. One, two parts of that answer. The first was figuring out and understanding that all of the highest quality hospital operators, so think of like the HCAs of the world that's under Tom's coverage, the ones that are best capitalized and financially the strongest, they understand and in fact they demand that they own their own real estate, that they don't sell it and lease it back, which is MPW's model. And the reason why is because in many cases, particularly for safety net hospitals in rural areas, the margins are so thin pre-rent that there's essentially no capacity to add a rent expense or a rent burden underneath that. And that's effectively what MPW's model is. What they do, and what does that mean? What it means is the whole thing lends itself to what's called adverse selection, where the biggest kind of best capitalized, most financially healthy operators are like, you know what, no thanks. Like, we want to own our own real estate. And the ones that are struggling for any number of reasons, unfortunately, they go to this market essentially like where MPW like is a loan shark. And, it pays the highest price for the real estate and charges what I think is an above market unsustainable rent back to the operator and like lights a fuse under the whole thing. And MPW is the only REIT that does this. So like it was a combination of like the operators, the highest quality operators that are profitable not wanting to do this, the lowest quality operators maybe not having no other option, and MPW being the entire market. Like that is a broken business model. It's not sustainable. It doesn't lend itself. It's kind of like what we see in Steiner's space when he talks about the subprime car or auto loan market, right? Or like the Affirms of the world. It only works so long as you have external financing available to you at all times to kind of like keep the whole thing going, because, and I'm talking about MPW here, because your tenants are of such weak credit quality and they're struggling so massively that they can't sustain themselves. The next step was then discovering that MPW loans money to its tenants, which is insane. Like it, when we've seen this over the past year, early on, they very kind of like publicly said like, oh no, we don't do that, or like that won't be necessary. They lend money to their biggest. They lend money to all of their tenants, but they lend money to their biggest tenants who turn around and owe them several $100 million of rent every single year. And I'm not saying that that's necessarily illegal. I'm saying that that's a business model I don't want to invest in. And if it's misrepresented, excuse me, if it's misrepresented, that's when it kind of trips over the line into like are you painting an accurate, fair, and honest picture of what your business actually is? But then so like, that's the first question, like, is the business model sustainable or not? And like, I think my answer was no. But then there was this whole other kind of like, how to say it? Like, I don't want to use the F word specifically because that's for someone else to adjudicate. What I've really tried to do is present the facts and the evidence and like leave a breadcrumb trail and let everyone kind of come to their own conclusion. And to me, look, I know what my answer is. I know what my conclusion is. I don't want to force feed that onto anybody else. Let everybody else decide. But here's what I would say. In the REIT world, many REITs develop, okay? Typically, you have an in-house development team. You own the land. You're going to wind up owning the property and leasing it to a tenant. So you handle all of the development responsibilities yourself. There's like an in-house team. Maybe you hire a series of third-party contractors and subcontractors, but you're the money, right? Like, you're the property owner. You kind of handle all the development. I can look across the entire REIT space and see every single one, pretty much every single one that I know of, or every single one that I know of does it that way under that model. Late in 2021, again, Steward Health, it's now like a 25, like if you pro forma it, it's probably about 25, a quarter of MPW's cash EBITDA. And the real big problem spot in the portfolio, and what I think is ultimately going to blow the whole thing up. It may very well be in the process of doing that as we speak. But anyway, our big part of our thesis is that this tenant is effectively or actually insolvent, and that MPW was the only lifeline to it through loans, CapEx support, any one of the number of mechanisms. But anyway, so late in 2021, a development down in Texarkana of a new hospital called Wadley Regional. It's a replacement hospital for an existing Steward-operated hospital in Texarkana that is one of the three, I believe, that MPW doesn't own. But the point is they were going to own this one. They're going to spend about $2 million a bed for a new hospital development in a market, in a state where like the other Steward hospitals are struggling, including one having closed. And in late 2021, there was a groundbreaking. But what was interesting is that MPW wasn't there. Steward did the groundbreaking with the city. And I remember there was no mention on the signage or the collateral or in any of the publications that MPW, as the developer and owner of the property, was there for a groundbreaking of this new asset. And I remember thinking to myself, man, that's weird. I've never seen that before. And sure enough, in subsequent disclosure, which by the way, they started putting out after we showed up, I think that the pressure that our work put on them publicly kind of forced them and forced the shareholders to demand increased disclosure around a lot of the stuff that we highlighted. But regardless, MPW advanced about $50 million to Steward as the, what seemingly, and conveyed the development responsibilities for this asset to its tenant. Now, that is by the way, the biggest tenant, right, that owes them back money. That is highly irregular. And my thought was this is odd. This could be effectively like a working capital loan potentially. And fast forward to the back half of last year, there was no activity at this site. And so I hired a photographer to go out and kind of see what was going on, because again, you had already announced the groundbreaking. MPW had, funded 1/3 of its total budget on the project. And all that was there was an empty field, literally an empty field. And famously now, a kicked over porta potty. And we had kind of a funny legendary moment on the call where, when I reported on this or kind of let everybody know about it, Keith very famously said, well, I don't know anything about MPW, but I do know this. I worked in construction, and things are bad when they kick the shitters over, which was, hilarious. But look, it's entertaining, but there's a big kernel of truth in here. Someone please explain to me how and why this company advanced $50 million to its tenant to build this hospital, and literally we're a year and a half in, and it's still essentially a vacant field. it's had a second groundbreaking, by the way, also conducted by Stewart in the city, and MPW wasn't there at that one either. Now, all I'm saying is it's irregular. It's not normal. We haven't gotten a good explanation yet from the company. And it fits with a pattern in which MPW bends over backwards, as it has throughout the years, to do everything it can to support its largest tenant monetarily and to obfuscate that. And I just posit that, like, again, at best, that's not a business model that I want to be involved in. At worst, it could very well be something else, and that's for someone else to adjudicate. But so business model question, unsustainable, but then like just kind of practices and ethics and, you know, functioning as an above board entity. Like I struggle, I really struggle, and I've tried to find any check marks on that side of the ledger either.
Amazing. I think, yeah, I remember that moment as well in the call. That was definitely one of those morning call moments that will go down in history. That was incredible. I love that finding. That was so good. So definitely don't let up the pressure. Keep going, you know, get them honest. At some point that'll work. Or it'll disappear. We don't have that much time because I want to keep it to a certain level, but I want to like switch it just a sec first. You and I had some slacks going back and forth where I kind of like threw like a very large overgeneralization at you about the space, and you were like, ha ha ha. So I want to jump into that because I still have that in my head a little bit. But like your space, REITs in general, require or thrive off of low interest rates or falling interest rates. Tell me why that's not true. And I guess like the two things that when I think about REITs, like the two things that really stand out in my head are interest rate reversal from acquisitions are easier and easier and so on and so forth to they cost a lot more. And then the other piece is, obviously like on the office side, massive underutilization and we have COVID underutilization and work from home elements, but then there's also headcount reduction elements where companies are now we're in that side of the economy where people try to rationalize their footprints and things like that. So tell me why that's not like and it's levered. So like, isn't that like the most beautiful area for shorts? Because these companies, as soon as they hit the refi button, like it's going to blow up these companies. Like I'll just give you a small example. Like we had one company in software just raised capital in, I think it was January, early February. They did a big cap raise at 8.75% coupon. I mean, this is like a software company that in theory generates cash flow and so on and so forth that 2 years before could have had a 0% coupon bond, for like forever, like free money essentially. So I'm like, that's obviously like a big signal and it hurts their business model, but there's things they could do to change. Like, I'm just wondering on your side, isn't this like a time game? Like, are like a ton of refinancings that as they come due are going to be basically like end game for a lot of these companies?
Yeah, that's a really good question. And so that's what, for anyone who listens on the call and kind of listens to Keith and I go back and forth, that's one of the the biggest themes in real estate right now. And Ami, you kind of, again, this is just my view of the world. I'm sure there are people who will disagree. Actually, let me I'm going to go back and I'm going to tell a story from my career that was kind of like an eye opener for me. I actually spent several years in my career at a REIT called Paramount Group, ticker PGRE. It's an office REIT that owns, I think about 70% of its portfolio is in New York, another 30% at this point in San Francisco. I was there for about 3 years. I did, IR, a bunch of other things, lots of stuff with the board, a couple different things. But it was fascinating. It was a great experience. It was fascinating. But one of the things that always kind of struck me as not making a ton of sense was, all of the New York City office REITs, with maybe the exception of ESRT, are very, and maybe Vornado too because of their cash, but they're very highly levered entities. So, SL Green is obviously the biggest kind of like problem spot right now, given their leverage, and we can talk about that. We've had that one on the short list, but the Paramount's levered 9 times, and I use cash EBITDA because, again, like, you know, we've tried to make this point with MPW. You can't service your debt with non-cash revenue. I'm not really sure why people don't grasp that. It's, you know, anyway, but so cash EBITDA to my mind, and cash EBITDA relative to debt service are the kind of the correct metrics. And I was in meetings, both as a sell-sider and then working at Paramount, where, like, you know, we'd walk in and, you know, buy-siders would say, like, hey, you know, like, you know, 8 times, 9 times leverage, it's kind of pushing it. You know, how do you think about that? And like, one of the things that would be said is, and it's pure narrative, is like, well, not all leverage is created equal. Meaning, like, there's a difference between secured leverage, unsecured debt at the topco level, you know, differing maturity profiles, all of that stuff. And that is true. But in the public markets, when asset values compress, all else the same, the more dollar leverage you have in your structure, the more your equity is going to compress against that in an amplified way. It's just simple math. And I think, so, like, that was really eye-opening for me, because that was like one of the most pure, like, bullshit narrative kind of things that I had seen, where I was like, yeah, that guy's like, this is nonsense. Like, this doesn't make any sense at all. Like, how can anyone take this seriously? And now where we find ourselves, and it really gets down to the degree of leverage, right? So, like, interest rates have came down over the, you know, the last decade up until last year. And cap rates, put simply, cap rates are just kind of like the inverse of an EBITDA multiple, more or less, at the property level. Like, real estate investors think of things in yield terms as opposed to multiple terms. But you know, cap rates came down alongside interest rates as like a reference point, just like multiples expanded, right? Like, it's the inverse of the two, or the reciprocal of each other. So, you know, whereas a decade ago, maybe you were buying an asset at an 8 or 9 cap. Now you're buying an asset at a 5 or 6 cap. You can make that math work with 5 or 6% interest rates, so long as you keep your leverage down, right? Like, if you're levering the building or the company 20 to 30% and having to borrow at 5 or 6%, you can still make money. But if you know, your cap rates, your in-place cap rates are like 5 or 6% and not really going to move for this foreseeable future because of the term of your leases, and you levered yourself up 60, 70, 80% or more at previously low interest rates, and now having to refinance and roll your debt, like, that math just doesn't work. Like, you're mathematically guaranteed to lose money because of the negative leverage effect. And, like, that's the kind of thing that's happening to SL Green. That's what's happening to DLR. That's what's happening to MPW in a very, very material way. So yeah, it's kind of like this, it's like Sam Zell says, right? Like, famous, I think I said this on the call, like, the problem with leverage is you have to pay it back. A very, very famous line from him. And for better or worse, the real estate world has made a one-way levered bet, by and large, particularly amongst the privates over the last decade. And now they have to figure out how to deal with that. Like, how to kick the can, how to, you know, term out your debt attractively, how to, you know, sell assets somehow, and not dilute yourself to such a large degree that you impair the RemainCo while still paying off, you know, your debt as it matures. It's a real box. And so, like, what I've tried to do, and you can see this on my position monitor, like, one of the pushbacks I get from clients sometimes is like, hey, you know, your longs aren't moving around that much. They're really boring. You know, they're low levered, low, you know, kind of consistent growers with low leverage, like low beta, all those style factors. And I'm like, yeah, but you know what? Like, I can't responsibly recommend some of this higher octane stuff because we don't know where a lot of the bodies are buried, and some of these things are going to blow up. And so, like, for now, until we get through this, boring is good. And like, I'm totally fine recommending to both institutional and, you know, pro subs that, like, hey, like, let's at best lose less money on the long side and hunt some of the higher octane garbage on the short side. and like make our money that way, because that might be the best we can do.
So that actually answers a different question that I had for you, which is like, describe your sort of like ideal long. But I guess ideal long right now is different than your ideal long kind of like in a general cycle. And so maybe that's something that maybe let's use this as the kind of like the last question here, the very last one, I promise, for today, is when it's not the environment we're in right now, what describe your like ideal long in the REIT space?
Oh yeah, that's a great question. Really good way to end. So I think that like, I know that one of the variables that is just like kind of serially underappreciated in the real estate world is just how capital intensive some of the models are. So like take office, like we were just talking about, right? When I was at Paramount, and this is pre-COVID, we were routinely talking about the recurring or maintenance CapEx load to the landlord, aka Paramount, being 20 to 25% or more of NOI over long periods of time. And that number has escalated materially coming out of COVID, because you have to you may have to give tenants more inducements or CapEx allowances to get them to lease with you just to keep your rental rates up. Now contrast that with like the tower space, maybe bleeding over into Andrew's world a little bit, where essentially all you have is an erector set and all the equipment is maintained by the operator. So like the, Verizon, AT&T, or T-Mobile will lease space on the array, put their antenna and all their equipment, and that's their responsibility, and all they do is pay rent subject to an escalator. And that erector set is owned by American Tower or SBAC, and essentially like there's really no capital you have to put into that. Or take self-storage, where CapEx is maybe like 6 to 8% of NOI, or multifamily where it's 12%. I guess what I'm saying is like these businesses, they compound on the top line, but they're very capital efficient and relatively asset light. And so there's this really like interesting compounding effect over a tail duration, using the Hedgeye framework, where things compound nicely and in a capital efficient way. And then like the capital intensive stuff is, your office, your retail, your data centers. It's a little trickier, or hotels and pod space, although like I'll let him comment about that. It's trickier and more cycle dependent, and you can't like make as a high probability bet that it'll compound, like kind of like a set it and forget it compounder over time. So that's really what I look for. And like, for example, I have SBAC and NSA on the long side right now. They definitely fit that mold, but they're tail longs.
Awesome. I do have more questions, but I'm going to leave it because we've filled up the time. Rob, thank you so much for being our guest today on Unscripted Equity Curiosity. This has been season 3, episode 10. And thank you for listening, everyone. And thanks, Rob, for your time.
Be well. Thanks a lot for having me. This is awesome, guys. Talk soon.
All right. Talk soon. Take care, Rob.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.